Right now, while you're watching this, somewhere in the world, a system is reading a satellite photograph of a Walmart parking lot in Ohio. Not because anyone cares about the parking lot, but because the number of cars in that lot, measured across 4,000 store locations, averaged over 6 weeks, is a more accurate predictor of Walmart's quarterly earnings than anything Walmart will tell you in their official press release. The earnings call is in 3 weeks. The system already knows. Meanwhile, a retail investor is reading an article from this morning. It says, Walmart looks strong. The analyst has a price target. The investor feels informed. They are not uninformed. They are just operating in a completely different reality. This video is not here to tell you that quant funds use algorithms. You know that. This video is here to show you specifically the software, the data pipelines, the infrastructure, the price tags, of what is actually running on the other side of every trade you make. Because the gap between what you have access to and what they are operating on is not a slight advantage. It is a different world entirely. Let's start at the foundation, before any model runs, before any trade is placed, before any algorithm makes a decision. The data. It all starts with data. Not the data you know, the data you don't. Most people think financial data means stock prices, earnings reports, economic indicators. That's the data you get. That's what's on your screen right now. Here is what they get. Roughly 90 commercial satellite companies are currently orbiting the Earth, capturing high-resolution images of economic activity on the ground, constantly. Geolocation and satellite imagery data have become essential tools for analyzing economic activity, capturing details about infrastructure changes, environmental conditions, and location-based insights. But here's how it's actually used. In concrete terms, in retail. Investors use satellite imagery of parking lots at retail stores to estimate foot traffic and sales figures, providing early indicators of company performance, weeks before official earnings data is released. In energy, oil storage tanks have floating roofs that rise and fall with the level of oil inside. Satellites measure the shadow cast by that roof. More shadow equals lower oil. Less shadow equals higher oil. Hedge funds track global oil inventory in real time, not quarterly, not monthly, constantly. In agriculture, satellite imagery reads the spectral reflectance of crop fields, essentially the color and heat signature of plants, to predict yield before harvest. Commodity traders are positioning months ahead of the actual supply data. In shipping, port activity, the number of containers stacked, the number of ships anchored offshore, is tracked via satellite to predict global trade volume before any government publishes its data. This is not science fiction. In 2018, investors used corporate jet movement data to predict Warren Buffett's Berkshire Hathaway investment in Occidental Petroleum before it was announced. Nobody hacked anything. Nobody had insider access. The flight data was technically public. The pattern recognition was theirs. Every time you swipe your card, at a restaurant, a pharmacy, a gas station, that transaction joins an anonymized pool. Alternative data refers to information collected from non-traditional sources, including diverse datasets such as social media activity, satellite imagery, web traffic, and workforce analytics, offering unique insights and revealing trends not visible through conventional data sources. Here is the specific mechanism. Data aggregators purchase anonymized transaction records from credit card networks, payment processors, and financial institutions. They clean and structure this data. They sell it to hedge funds. What does a hedge fund do with your swipe at Chipotle? Individually, nothing. Your purchase means nothing. But aggregate 40 million transactions across every Chipotle location in the country, tracked week by week, and you now have a real-time picture of Chipotle's revenue, right now. Not in the next earnings report. Right now. Weeks ahead of when the company will disclose it. Research shows that stocks receiving sudden increases in negative sentiment underperform the market measurably in the following month. Credit card data showing declining restaurant traffic, analyzed at scale, has the same predictive quality. Hedge funds using transaction data boost prediction accuracy by 10%. That might sound modest. At the scale these firms operate, billions in positions. A 10% improvement in prediction accuracy is worth hundreds of millions of dollars annually. Natural language processing, NLP. You've probably heard this term, but here's what it actually means at the scale these firms operate. A system is reading, right now, every article published by every financial news outlet, every earnings call transcript, every regulatory filing, every job posting, every product review, every Reddit thread, every tweet about a company, not skimming, reading, processing, classifying sentiment, measuring tone shifts, detecting language patterns that, historically, precede stock movements. A 2018 study showed that analyzing sentiment on platforms like Twitter could predict stock market movements up to 6 days in advance, with an accuracy of 87%. Here's the specific application that most people don't know about. Earnings call language analysis. When a CEO speaks on an earnings call, the words they choose, not just what they say, but how often they say certain phrases, whether they're more hesitant than last quarter, whether they avoid answering a specific question, are fed into NLP models trained on decades of historical call data. The model doesn't need the CEO to say, "We have a problem." It detects the linguistic fingerprint of a company in trouble before the numbers confirm it. Job postings are public. Anyone can read them. But here's what a systematic analysis of job postings reveals. If a company suddenly starts posting for supply chain roles in a region where they have no current operations, that's a signal of expansion. If they stop posting for software engineers in a division that has historically hired heavily, that could signal the division is being wound down. If a company's Glassdoor reviews suddenly shift from positive to negative in a specific department, that's potentially a signal that something is wrong internally, months before it shows up in financial results. Workforce analytics boost earnings prediction accuracy by 18% for the funds that use them correctly. None of this data requires any hacking, any insider access, any illegal activity. It's all public. The advantage is not access to the data. The advantage is the infrastructure to read all of it, simultaneously, faster than any human or any conventional system possibly could. Now, let's talk about the software. Before we get to what quant firms use beyond Bloomberg, let's be clear about what the Bloomberg Terminal actually is. The Bloomberg Terminal is an all-in-one financial data, news, and analytics platform. It gives subscribers real-time data across every asset class on Earth. Stocks, bonds, commodities, currencies, derivatives, all of it, alongside research, communications tools, and analytical functions. More than 350,000 financial professionals use it every day, from hedge fund managers and investment bankers to portfolio analysts and traders. The price, a single terminal license, costs approximately $32,000 per year, or more than $2,600 per month. For independent investors and small firms, that's simply out of reach. But here's the critical thing to understand. For top-tier quant funds, the Bloomberg Terminal is not their edge. It is the floor, the starting point, the baseline. The Bloomberg Terminal tells them what everyone else with $32,000 per year already knows. Their actual edge lives in the layers above it. Software number 2, KDB+, the database that runs Wall Street. There is a database used by Goldman Sachs, JP Morgan, Citadel, and virtually every major high-frequency trading firm on Earth. It processes billions of financial records in milliseconds. It has been the backbone of institutional trading infrastructure for over 2 decades. Most people have never heard of it. It's called KDB+, developed by a company called KX Systems. KDB+ is a column-based relational time series database, commonly used in high-frequency trading to store, analyze, process, and retrieve large datasets at high speed. It has the ability to handle billions of records, and financial institutions use it to analyze time series data, such as stock or commodity exchange data. Here's what makes it different from any database a normal company would use. KDB+ integrates real-time and historical data seamlessly. So, the same query engine can process both a live market feed and decades of stored data. This is invaluable for trading desks that need to backtest strategies, monitor risk, and react instantly to new market conditions. Its efficiency comes from its extremely lightweight runtime, capable of handling billions of rows in milliseconds without the overhead of more general-purpose systems. Think about what that means in practice. A trader needs to know, given everything that has happened in the last 30 years of market data, every comparable scenario, every similar pattern, what is the statistically expected outcome of this exact market condition in the next 15 minutes? Software 3, Ravenpack, turning news into signal. Ravenpack is a platform most people outside institutional finance have never encountered. It does one thing. It turns unstructured financial text, news, earnings calls, regulatory filings, even social media, into structured, machine-readable, real-time data. Using advanced NLP and machine learning, it converts global information into quantifiable signals. Its clients, the world's top hedge funds, banks, and asset managers. The moment a news article is published, anywhere, in any language, Ravenpack has already read it, identified every entity, measured sentiment, assigned a score, and delivered it as a data point. Before a human finishes the headline, the model has already acted on it. Funds aren't paying for news. They're paying for structured output, processed at machine speed, fed directly into trading models. Software 4. Palantir Metropolis, the invisible analytics engine. Palantir is widely known for defense and intelligence. What's less known, its platform, Metropolis, has been used by hedge funds and financial firms for large-scale data integration and analysis. Its core strength is connecting datasets that were never meant to interact. Satellite imagery, transactions, news, internal trades, macro signals, into a single analytical system. For a hedge fund, that means one interface where a manager can ask, what's the relationship between shipping volume in Shanghai, consumer spending in the US Midwest, and the earnings trajectory of specific retail companies, and get a unified answer across all data sources. Pricing isn't public, but contracts often run into millions annually. Most firms don't even know it exists as a financial tool. Software 5, Yipit Data, and the Alternative Data, Edge. Yipit Data, now Veracast, is one of the largest alternative data providers. It aggregates consumer transactions, web data, app usage, and more, turning them into structured datasets for institutional investors. In practice, before companies like Uber or DoorDash report earnings, their models are already tracking app downloads, session time, and transaction trends, giving funds a forward view of revenue before it's publicly released. Platforms like Yipit Data and Sentio use machine learning to turn raw data into signals, reducing the timeline from weeks to hours. The alternative data market is projected to grow from $4.8 billion in 2024 to $34.6 billion by 2032. Not because companies want better insights, but because funds are paying for one thing, information the market hasn't priced in yet. Now we get to the part that sounds like it should be in a novel, because even if a fund has the best data and the best software, if their order arrives at the exchange, 1 millisecond after another firm's order, they lose. So they solved the problem the way engineers solve problems. They went to physics. Infrastructure 1. Collocation, getting closer to the market. Stock exchanges run on a central system, the matching engine, where every trade is executed. Firms don't just connect to it, they move next to it. Collocation means placing servers inside the exchange's own data center, meters from the matching engine. Because here, distance isn't space, it's time. In one setup, being just 50 meters closer, cut latency by 200 microseconds, 0.0002 seconds. Even geography matters. Shifting from New York to New Jersey, closer to the exchange, can save around 1 millisecond. A hedge fund, co-located inside the exchange, can execute trades in under 1 millisecond, while a retail trader, operating from elsewhere, faces delays of 10 to 100 milliseconds. That's up to a 100 times disadvantage, before your trade even enters the market. Infrastructure number 2. The $300 million cable that saved 3 milliseconds. In 2008, a trader named Daniel Spivey studied a map of the US. He noticed something simple. The fiber lines between Chicago, futures, and New York, stocks, weren't straight. They followed roads, railways, existing paths. So he imagined a straight line, cutting through farms, forests, even mountains, just to save time. Cost, $300 million. Gain, 3 milliseconds, 3 milliseconds. The cable was built, because in this world, 3 milliseconds is worth $300 million. Infrastructure. Number 3, microwave towers and the speed of air. Then came another realization. Fiber carries light at about 2/3 the speed of light, because it bends through glass, not in a straight path. Microwaves travel through air, closer to a vacuum, and move faster in straight lines from tower to tower. In practice, they can be up to approximately 50% faster than fiber over the same distance. So HFT firms built microwave networks between major exchanges, Chicago to New Jersey, London to Frankfurt, to exploit that edge. The goal, use as much air and as little fiber as possible. But speed comes down to details. So, the receivers must sit on rooftops or right beside data centers. If something blocks the path, firms lease rooftops just to position antennas. This is what winning by microseconds looks like. An antenna on a building you don't own, in a city you don't operate in, linked to a tower kilometers away, all to be a few microseconds faster than the competition. Infrastructure 4. FPGAs, chips built for nanoseconds. Standard CPUs process instructions sequentially. For most systems, that's fine. For high-frequency trading, it's too slow. Enter FPGAs, Field Programmable Gate Arrays. These chips process data at the hardware level, cutting latency down to nanoseconds. They take in raw market data, bypass the operating system entirely, and compute trading decisions in microseconds. That bypass is critical. Traditional systems rely on an OS to manage memory, inputs, and scheduling. That overhead costs time, tiny in normal computing, but fatal in HFT. FPGAs are built for one purpose: receive data, compute a decision, send an order, with no OS, no general processing, no delay. A standard CPU might take around 10 microseconds to act. An FPGA can do it in under one. That difference isn't just speed, it's operating in a completely different timescale. What the machines are actually doing with all of it. Let's bring it together. Because the real story isn't any one tool. It's what happens when all of them work as one system. A top quant fund today runs a pipeline ingesting, in real time, satellite imagery updated daily, millions of credit card transactions, NLP sentiment from global financial text, job postings, app usage from millions of devices, weather data, jet tracking, shipping volumes, and dozens of proprietary alternative datasets. All of it is cleaned and fed into machine learning models, running on KDB plus databases that query billions of rows in milliseconds, paired with FPGA systems that act in nanoseconds, on servers co-located inside exchanges, linked by private microwave networks, and above it all, an AI layer. At Bridgewater, the goal is to replicate Ray Dalio's macro thinking end-to-end, a system described as millions of analysts working in parallel. At DE Shaw, teams can build tools in minutes, while centralized controls enforce strict governance. Bridgewater runs layered checks, fact retrieval, policy filters, statistical validation, cutting error rates from 8% to 1.6%. This isn't a trading desk anymore. It's a planet-scale information machine, pointed at the market. The Medallion Fund, the extreme case. Then there's Renaissance Technologies, founded by Jim Simons, mathematician and former codebreaker. He didn't hire traders, he hired scientists. Their Medallion Fund is closed to outsiders, yet has produced unmatched returns, even after 5% fees and 44% of profits. Its strategy is one of Wall Street's deepest secrets. Employees have been fired and sued for trying to leave with knowledge. Turnover is near zero. What we know. They stopped treating markets as finance in the 1990s and started treating them as pattern recognition. Their systems are entirely proprietary, built over 40 years by PhDs. That's the ceiling of this infrastructure. What this means for you. This isn't to scare you. It's to clarify the environment you're in. Retail investors rely on earnings, news, charts. That information isn't useless, but it's often already processed, priced, and traded on before you even see it. Top quant funds have pushed alternative data spending from approximately 10% of research budgets in 2020 to over 30% by 2025. They generate 180 to 340 basis points more alpha than traditional strategies, and that gap is widening. But here's what's changing. Some tools are becoming accessible. Platforms like Quant Connect, cheaper alternative data, open source machine learning. The gap exists, but it's not permanent at every level. What matters is awareness. When a stock moves before news, this is why. When earnings look normal but price drops, this is why. When volume spikes weeks early, this is often why. The market isn't just people anymore, it's machines, with better data, faster systems, and signals you don't see. That doesn't paralyze you, it calibrates you. None of this is hidden. Bloomberg Terminal exists publicly. KDB Plus, Ravenpack, microwave networks. They're all visible if you look. The gap isn't secrecy, it's awareness. Most people don't know these systems exist, or what questions to ask. And on the other side, a machine built by hundreds of PhDs, running on massive infrastructure, fed by satellite data, transactions, and global text, is placing a trade. It doesn't know you. It doesn't need to. It just knows what the parking lot looked like this morning. The question isn't whether you can beat the machine. It's whether you understand the game you're playing, and who else is at the table. Quote, now you know. Welcome to the Inflection.